There's another message that I want to tell you today, is that within our mandate, the ECB is ready to do whatever it takes to preserve the euro. And believe me, it will be enough.
This was a historical comment by the then head of the ECB, the European Central Bank, that they would do anything to save the euro. Unfortunately, despite the promise of the major bureaucrats and politicians, we're likely to see the end of the euro.
I had to do it. It was the COVID crisis. You say that's what we needed to do. But how do you get it?
It will
back?
come. It will come. In due course. Yeah.
How?
In due course, it will come.
Yeah.
Macroeconomically, we're seeing the world completely change. Inflation is all-time high, and most of the major central banks, including the ECB, the Bank of Japan, and the Fed, are stuck in their own trap. Japan, Europe, and the US are all seeing the same problem. Inflation at all-time high, debt increasing, and they can't do anything about it. But the European Central Bank is the worst among all of them. Let's take a look. Why is that? The credit-based global financial system is at its end. It's like a game of musical chairs where we need to keep adding people and chairs, else the game ends. The West has run their capital account mostly in deficits. But that excludes the European Central Bank, and that's mostly because of Germany. But that changed recently because of the energy crisis caused by the Ukrainian war. Germany needs to import natural gas in order to heat up their residences and produce energy for their industry. But energy has gotten really expensive. And so you can see Germany has run into a deficit in the past year. The interesting part in Europe is that there are imbalances between countries and how much deficit or surplus they have. And so countries that have a surplus, like Germany or northern countries, actually provide money to countries like Spain, Portugal, and Greece. And that's what's called Target 2. So what happens is that, for example, Germany sends out submarines and cars to Greece. And Greece pays for that, but they run a deficit. And in Europe, because each country doesn't have its own central bank, in order to stabilize the currency between different countries, they have this thing called Target 2, which is basically debt. So in order to stabilize the amount of money that are in different countries, Germany and other northern countries send money to PIGS, Portugal, Italy, Greece, and Spain. And as you can see, Target 2 has been growing over time, and that has been causing pressure in different countries. The problem is that this imbalance has grown over time, and because the whole European Union is running a deficit, the European Central Bank needs to print out money to buy debt for all different countries. So that will increase inflation. And the problem is that countries have no incentive to run a surplus. So the deficit will keep increasing and the money printing will keep increasing. And because each country doesn't have a central bank, what happens is that we have an authority at the center that's buying different bonds for different countries. So in 2011, that's what happened. As you can see, in 2011, there was a huge difference between bonds issued by the Greek government and the German government. The market thought that the Greek government wouldn't pay its liabilities, so the ECB started printing money and buying Greek bonds. And as you can see in this graph, eventually Greek bonds were deemed as risky as German bonds, so the risk went down. But the amount of money that was printed out, as you can see in this white line, went up a ton. And that's likely to keep happening. And so the European Union is trapped. Inflation was already high before Russia invaded Ukraine. Now after that, inflation will keep increasing over time. All central banks will see that. One likely scenario is that the European Central Bank keeps printing money, increasing inflation around the European Union, and buys bonds of the southern countries. That's a huge problem. Northern countries like Germany won't like that, and they are likely to elect populists so they can move out of the European Union. The other possible scenario is that countries like Portugal, Spain, and Italy, they actually default, and they are likely to move to their own currency so they can actually pay their own debt. Either way, we're likely to see the euro fall apart. And England moving out of the Eurozone is just the beginning. I hope you like this video. If you like more videos like this, please watch this video. Thank you and see you.